friends, this is Professor Amarjeet Kaur. I am teaching accounting primarily at Department of Management, Gurugram University, Gurugram. I have been working from last more than 3 decades now. I have been fortunate to work in 2 universities in USA and have worked in food industry of India as well. I have authored or edited 12 books and 64 or 65 research papers have been authored. So, I am fortunate that I am here with you to talk about financial institutions. This is part 2 of financial institutions which I am going to talk about. In part 1 we talked about, if you are keen to learn that, you can refer to part 1 of financial institutions, where we talked about what are the functions of financial institutions in India, what is the importance of financial institutions. So, that is a very important part, the introductory part of financial institutions. Today, I am going to talk about types of financial institutions in this part 2 of financial institutions. So, friends, we understand that any economy works basis on many important pillars, be it financial markets, be it financial institutions, financial services. So, that is how any economy has many players, producers, consumers, etc., etc. Within the economy we have many systems, and one of the important system is financial system. In financial system we have many pillars: financial institutions, financial services, financial instruments, financial regulators. And agenda for today is to talk about financial institutions and their types, right. So, I hope you are able to connect that what I am going to talk about. So, financial institutions, they are foundation for any strong economy, right, because they are essential for economy to prosper, to recover, to grow. In fact, any economic growth is possible because of financial institutions. If you go and watch the part 1 about financial institutions, we discuss about that, how regional stability is possible because of financial institutions, how funds are mobilized because of financial institutions, how allocation of resources is possible because of financial institutions, how depositor is able to deposit and earn interest, how someone can seek seek advice from the financial institutions, how financial institutions support the demand of funds in different sectors of any economy, right. So, even how the risk is mitigated through insurance, etc. So, there are so many important parts of financial institutions played by financial institutions. So, that is very important that we understand the types of financial institutions. There were times when financial institutions were limited to providing only traditional banking services, only deposit and lending. When the banks started in, of course, before independence, the banks were there. So, and later on, and thereafter we came up with nationalized bank, and then insurance companies emerged, then advisory bodies came up, etc., etc. That is how that system has grown up. But initial days, if you go back, a couple of centuries back, when the financial institutions started, the primary role was only traditional banking services, means deposit and lending. Only 2 primary things were undertaken. But gradually, when the capitalist economies grew up and the development agenda of banking system, so in fact the banking system or financial institutions, they became part of development agenda of any capitalist economy, be it India or any other capitalist economy. So, that is the background about the role financial institutions have played, and they have emerged or they have changed their role in fact. So, when it comes to the today's agenda, which is types of financial institutions, financial institutions offer a variety of financial products and services to individuals and to businesses, to both, for individual consumption and for business consumption. So, through specific services offered by them, they which of course vary, between different types of financial institutions. So, we divide financial institution into 3 broad categories basis on the services provided by them. It means there are specific institutions for certain type of services and there are specific institutions for some other type of services. So, basis on the different type of financial services provided by these institutions, we group them into 3 broad categories, and then I will talk about that detail of financial institution. So, what are those 3 types of financial institutions? All the financial institutions which work in an economy, they fall under 3 categories. Number 1, depository institutions. Number 2, investment institutions. Number 3, they are contractual institutions which we call them as non-banking financial institution, NBFI is a very commonly known verb, right. So, depository, investment and contractual. So, now I am going to talk about financial institutions falling under these 3 categories. So, I will give you an idea that which are the institutions which fall under the first category, depository, which are the institutions which fall under the second broad category, investment, and which are the institutions which fall under the third broad category, which is contractual institutions. So, depository institutions, number 1, so in total financial institutions are number 1, commercial and central banks, number 2, saving and loans associations, number 3, credit unions or cooperative banks, number 4, foreign banks, number 5, industrial institutions or thrifts, number 6, investment companies, number 7, advisors, number 8, brokerage firms, number 9, assets management companies, and lastly number 10, insurance companies and pension funds. So, I will talk about these institutions in detail now, and I will let you know which of them are the depository ones, which of them are investment ones, and which one are the non-banking financial institutions. So, the first first category of institution, as I said, is commercial and central bank. The Central Bank of India, we all know, is Reserve Bank of India, RBI. So, all most of the countries, in fact almost every country has their central bank. India is having RBI, and so are the other banks, Federal Bank and all that banks are there around the world. And then we have commercial banks. Commercial banks are in the business of accepting deposits and giving loans, right. So, these are most of the banks which we would visit are commercial banks. So, it means there are non-commercial banks as well. So, that is what you will think of. So, commercial banks could be in the form of a nationalized bank, like we have SBI, Punjab National Bank and so on, or a private bank, you know that ICICI or HDFC, etc., etc., and the central bank I just mentioned. So, that is the first financial institutions category which falls under the depository institutions, right. As I said, there are 3 primary ones, so depository one. The second is saving and loans association. Saving and loan associations, they accept primarily savings and then loan. So, they do not do all the commercial financial activities. It means they are just accepting. So, they are known as associations accepting savings and giving loans, that is it. It means that savings could be from the general public or from members, and then loans to those members only, or right, or to general public, depending on what are the what is the memorandum of those association. So, this is again the depository institution. The third is credit unions or cooperative banks, as we call them in India. Cooperative banks are they came up as a in corporation and they have members. So, they are accepting deposits and giving loans only to the members, cooperative, right. So, in many countries they are known as credit unions, in other countries They are known as cooperative banks. In India, we call them as cooperative banks. So, cooperative banks are actually also primarily depository institutions, right. So, they are not investment institutions, they are depository, the first category. So, commercial banks, be it private, be it public, central banks, loan association, cooperative banks, they all these all banks are under depository. The fourth one is ban of foreign banks. Even the foreign banks are part of depository, because they are also extending the depository services. So, they accept deposits and then they extend. So, foreign banks are also coming under the first category, but there are foreign banks which could be into the investment as well. Okay. So, these first four I discussed, they are primarily under the first broad category of depositories or depository institutions. Now, the fifth one, which is industrial institutions, or they are also called as thrifts. Now, what are the, like SIDBI I said, there we have many such institutions. What are they? So, they are actually investment institutions. They are primarily generated to support industry. That is why we call them as industrial institutions, and they broadly fall under the second category, because under the three categories, depository, investment and contractual non-banking financial institution, the second category is investment. So, industrial institutions are doing what? They are primarily funding projects. Let us say X company wants to start a hydro plant in any part of the country, right. They really need huge investment, a solar plant, a power generation plant, where electricity is generated, any such, or any big company, any big setup is to be made. So, these institutions would be investing in industries. Nowadays, investment is moving in AI and GI sector. So, even that is provided by institutions, and those institutions are known as industrial institutions. Then there are separately companies which is, they are non-banking financial companies. I do not want to name because they are private companies, but if you just imagine, you will see there are so many of them. They are known as investment companies, precisely they are known as investment companies, but since they are actually investing, because any non-banking company can come up after approval from the regulators, and if somebody has good capital available which they can lend further and they can generate revenue as as interest being received. So, those companies are basically into lending. Just imagine a Lalaji which used to be, or still there are many small villages where we still have the Lalajis, giving small amount of loans to the public in a village, and they are charging a huge percentage of, a very high percentage of interest. So, they are Lalaji was not a company, it's a non-banking financial individual working into non-banking financial system, but imagine that Lalaji creates a company and seeks approval, because Lalaji has enough money accumulated. So, that is possible, and that is still is true. People say I have taken money open market se uthaya hai. In Delhi we have Sadar Bazaar, Chandni Chowk, Nebsarai, those areas which are very commercially active. So, Nai Sadak, etc. So, there we have so many agents, so many people running small companies who are lending money. Yeah, so they are actually investing, be it a small or a big money, but they are investing, they are earning on it. They have muscle power, they have all kind of systems to recover their lendings. So, they are non-banking institutions, but they are into investment, right. The third set of investment institutions, second set of investment institution, but third player, the first player as I discussed was industrial institutions. Second player I discussed in the second broad category investment is the investment companies, which are the non-banking companies like And third is advisors. So, what are advisors doing? Advisors are actually advising to invest as well as to to help you from where to seek money. Now, primarily they are into advising of investment. So, these are the people, they are assisting retailers or whole retail investors or even financial institutions broadly to invest. For example, investment companies may have advisors on their roles, or they may be seeking advisor service as and when required on the basis of a project or a proposal, both way. So, advisors could be nowadays gig economy is developing. So, advisor could be individuals or companies, both, right. Advisors could be in any form of business, any form of organization. So, advisors are helping where to invest, right. They are helping to investment companies and they are helping to individuals as well. So, this is the third component under investment category of financial institutions. The another, which is actually the eighth point in the whole scheme of discussion, but otherwise fourth, brokerage firms in investment institutions. So, what are the financial institutions which are into investment services? The brokerage firms. So, we have investment institutions, we have investment companies, we have advisors, and the fourth thing is we have brokerage firms. The brokerage firms, they advise, but they charge brokerage, right, on every suggestion they make to you. So, these are registered firms as brokerage. So, we have brokerage agents for sale and purchase of share, debentures, any financial institution instruments, etc. So, they are also working as a part of financial system, right, as financial institutions. So, it's not, banks are not only the financial institutions. Okay. The third is the contractual institutions. Here the under the contractual we have two types of financial institutions, which is under point number 9 and point number 10, which you may have noticed: asset management company and insurance companies and pension funds both. So, these are actually part of the third broad category, which is non-banking financial institution, but they are also taken or known as contractual institutions. So, AMCs are doing what? Asset management companies are actually helping fund managers, they are managing funds, the financial assets I am talking, I am not talking about the physical assets, right, I am talking about the financial assets. So, these companies are actually, for example, mutual fund are managed by companies. We have mutual fund managers. So, if you are buying SIP in a bank, from a bank, you are investing into mutual fund through SIP. Who is managing? The asset management company is managing those funds through fund managers, very intelligent people having very great exposure and experience. Those are the people who are working on your funds, right. So, there are so many asset management company. For one fund there could be more than one company, right, which is actually working on the fund. So, one fund is managed by many asset management companies, certain part 30%, 40% managed by X, but 40% managed by other, 20% managed by third company. So, one asset management company could be there in the management of funds, more than one company could be there in the management of funds. So, they are in the third broad category, which is basically contractual kind of thing, non-banking financial institutions. And the last part of financial institution is both insurance companies, which are into risk mitigation. Primarily, we are mitigating the risk of fire, loss of life, through fire insurance, motor insurance, house insurance, life insurance, all kind of insurance policies we are availing and using, health insurance. So, we are mitigating our risk. Health insurance is helping you to mitigate the risk of paying so much huge money to the hospital when in case you are hospitalized, in case you face some health issue, right. So, insurance companies are also known or also financial institution. They are the part of financial system. And the last is pension fund, which I have taken together, of course, as point number 10. Pension funds are also financial institutions. They are also non-banking financial institutions. They are not accepting deposits as on a retail basis. They are accepting money, of course, your money, and they are investing into funds with the help of asset management company or brokerage firms or advisors, and they are ensuring your fund grows, your pension fund grows, be it national pension scheme or otherwise provident funds, etc. And these funds are generating money for you and you are getting some returns on that. So, this is how the whole set of financial institutions under 3 categories: depository category, investment category, and the non-banking or contractual category are playing role in a financial system. I hope I was able to explain that. The last thing I want to discuss is limitations of financial institutions. In the part 1 of this topic, we talked about importance, function, and the last few minutes I was talking about the different types of financial institutions, and it gives you an idea that how important the financial institution or financial system is comprising financial institutions, right? They are the agents for economic growth, but so every coin has 2 sides. Same way, no system can be without limitations, and so is financial institutions. So, what are the limitations of financial institutions? There are few of them. Number 1, complex and lengthy process. Number 2, security deposit is an issue. Number 3, hidden risk involved. Number 4, hidden costs are involved. Lastly, limitations on the borrowers. So, let me just briefly discuss them before I wind up. So, complex and lengthy process for financial institution. If you have simply think of a car loan and housing loan, how much time does it take? Every banking institutions, every company claims that they are very fast in processing, but fact of the matter, it takes quite a long time if you have to avail a loan. Imagine the companies seeking loan in crores. Your car loan could be for 5-7 lakhs, your housing loan could be for 20-30-40 lakhs, and crore at the most, 2 crores of course, 3 crore, but small amount comparatively to a huge investment in a project to set up a new company, new industry, spread over acres of lands with huge machinery and plant investment. Imagine how long and lengthy the investment would be. Refinancing is done, in many companies. Merger and acquisition takes place, and that takes months. We get to hear that X company has been taken over by Y company, and the Y company has gone for refinancing option from a financial institution. So, imagine the kind of efforts that financial institution will be paying to review the financial health, to review the operational efficiency, to review the future cash flow generation capacity of the company which is to be bought by the investor, the other company. So, one X is selling a company, Y is buying a company. So, here and Y is getting the loan, the money to finance that purchase, that takeover. Here purchase is takeover, right. So, Y is taking over X, and in between comes a financial institution. Financial institution has a huge responsibility, big responsibility before accepting to invest in takeover of X, right, by Y, because it is a matter of assessing that how much cash would be generated in future. We are talking about future, because Y is taking over, but Y has to pay back the loan the financial institution will commit. Before committing, there would be such a long process. They would be getting business plans from you, there would be so many presentations, so many negotiation. Financial institutions basically they negotiate the loans which are project loans or terms loan. They are not at a fixed rate. Same amount extended to one company would be at 20%, another company it could be only 11%, because of the negotiation skill, of course, because of the possibility of generating cash, because of the liquidity assurance, because of the long term solvency of the company. There are so many factors. So, the process could be as lengthy as you can imagine, depending on the complexity, depending on the loan, depending on either you are a new business or a old business, depending on you are the first time buyer or first time loan seeker, what is your credit history. Then security deposits have to be made in many financial services. That becomes a limitation. There are many risks involved which are hidden, which are not known to you, right. We generally sign those agreements very quickly, but we ignoring the risks involved in signing those agreements with financial institutions which are giving you loan, lending you money or giving you advice, etc., etc. They say we do not undertake this, so this is your risk only. So, those hidden risks may not be known to all, especially if the person is not well educated, if person does not have the advisor, if person is bargaining himself herself without much exposure in the financial system. And then we may have hidden cost. Many loans given by, for example, if I take a loan from a bank and you have been told, oh yes, 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 you can pay beforehand, you can pay before the maturity period. The maturity period was 10 years, but in between you have good raise, you change your job, your salary is high, you want to get rid of get rid of loan. But when you intend to pay, you got to know there is so much of penalty on paying in advance, which is a hidden cost, which was not known to you, right. People take credit, people take ODs, overdraft facility, and then later on they got to know that there was so much of penalty in paying advance before the maturity. So, that is a hidden cost involved here. And then the limitation on the borrower part is also there. They may have no knowledge, limited knowledge, or borrower is not even honest enough to pay back. That corrupts the financial system, that increases NPAs, that destabilizes the banking system or financial institution or financial system for that matter. So, these are the limitations of financial systems. So, friends, I hope you were able to understand three broader category of financial institutions and limitations of financial institutions. We will continue with the discussion on financial system in future series as well. So, looking forward to see you in future. Thank you very much.